COVID elected you, inflation is going to cost you office. What counts for Biden can be said for the markets too. COVID giveth, inflation taketh. Today's consumer price index reading was over 6% annual increase in prices. Now, there's a lot of reasons for that, but people are absolutely scared of inflation. The psyche of the people, the zeitgeist on the street and on Wall Street is focused on inflation. Some of it is warranted. Some of it is, in my view, not warranted. We at Orange Capital Partners are fine because we think that our assets will do fine in both scenarios, with inflation or without inflation. However, we believe that there is one trigger that we haven't accounted for enough, and that is the deterioration of government institutions, which is actually leading to inflation. I want to discuss this, and that is, of course, increasing our risk and therefore also explaining the recent correction that we had in the portfolio. This is the Not Even Wrong podcast. It's November 10th, 2021. This is Krim Telco. For the day, the fund is down 70 basis points. The market is down 90 basis points. For the year, we are up 38.7%. The market's up 21.6%. We're outperforming by 17.1%. COVID elected you. Inflation is going to throw you out of office. This is what people are saying about the Biden administration. I think I can connect that to the markets and just say COVID giveth, the inflation taketh. So whatever COVID did in terms of money printing, loose Fed policy, all that stuff, it drove up prices, and now inflation is coming, biting us in the back, and the Fed is having forced their hand, and when they raise rates, it will cost certain sectors of the market, particularly the high growth sectors, the high PE sectors and all that, they will lose in value. This is the general sort of conventional wisdom, the consensus, and all these things. And I want to discuss this a little further. And then I want to outline the one risk that we think is actually that we underestimate, and that is the deterioration of government institutions, which is at least short-term going to lead to inflation. So first, let's talk about the narrative in the market. So we had all this loose money, and now we have inflation. It's driven by all the money that was printed, and therefore the Fed is going to be forced to to raise rates to stop that. This is, in short, the narrative in the market, and it's going to hit high growth stocks more than, let's say, I don't know, the Deere and General Electric and stocks like that. Now, I completely disagree with that statement for many reasons. First and foremost, we are still in a very low interest rate environment. Even if the Fed raises rates to 2% or something like that, if you have a stock like Tesla that has an internal rate of return of probably 50% plus, then even 2% still is absolutely nothing compared to given the opportunity cost of capital relative to the expected returns. Now, could we have a correction in the stock from, let's say, 1.2 trillion to a trillion or 900 billion in market cap? Yes, and we've already seen that. So that is perfectly warranted. But we don't think that the risk in terms of a real collapse or anything like that is imminent. Now, of course, there is also leverage in the market, and there's a possibility for forced selling and things like that. We don't know about that. It is likely, and when rates go up, the risk in a stock actually goes up because of the leverage that the investors have and not necessarily the company. This is actually a practical application of the Miller-Mondigliani theorem for all those people who take finance classes out there. Read about the Miller-Mondigliani theorem. It's a very interesting concept. It basically says that it doesn't matter how a company finances itself, because in the end it will be the investors that decide what kind of leverage is in a particular stock. Because even if a company doesn't use any leverage, the investors then will lever up themselves to mimic, sort of replicate the kind of leverage that reflects the efficient frontier, which would be the perfect balance between debt and equity that a company should have given the expected return and the risk-free rate and all these things. Now, this is finance. I don't want to go into theory. What the Miller-Mondigliani theorem basically says, it doesn't matter how you finance yourself as a company, the investors will take care of the leverage that is optimal for your company. Having said that, of course, there's also a possibility that investors overdo it with leverage, that they do too much of it, and this is the risk that we're running right now. This is the reason why everybody's talking about bubble and why a lot of people are saying that we could have a correction. It's not necessarily because a company like Tesla is overvalued or the prospects are being overestimated. In fact, most people in Silicon Valley would agree that they're being underestimated. The problem is the leverage in the market. The problem is investors, etc. So we could have a correction. The way we take care of that at Orange Capital Partners is that we make sure that our leverage is adequate to take a 50% correction or maybe even a 60 or 70% correction, and still we can survive with the fund, and also we can survive with our cost structure at the fund. This is very, very important advice to anybody out there. The purpose of this hedge fund is to give people a sense for what it feels like to run a hedge fund. Please make sure your leverage is adequate, because leverage can kill you, and you never know. Even if you're the most prudent investors, you are in bed with other people that might not be as prudent, and you could have forced selling in a stock, and that could lead to very dramatic situations in the market. So having said that, let's get back to the inflation conversation. Now, the way we see the inflation is it is driven by the deterioration of government institutions. This is what we mean with that. The problem with inflation right now is the stock supply chains. Supply chains are stuck everywhere. It's your local coffee shop, your local Whole Foods, it's the port of South Carolina, the port of LA. No matter where you look in the supply chain, there are shortages. The reason the shortages are there is because there is not enough workforce. Supply chain disruptions can only have two reasons, theoretically. One is that you have a mismatch in economic planning. This is what happened, let's say, in the Soviet Union. And the other is in a free market like ours, where people adapt and entrepreneurs increase assets when there's higher returns and all that stuff. The only reason you could still have shortages is because you don't have labor, you don't have work, you don't have access to people to actually do the job. And this is the way we see it right now. This is the main reason why we have those shortages. Just to give you an anecdotal reasoning, I think, for example, because of COVID, a lot of people are not showing up to work. Some of them warranted, some of them maybe less warranted because they're afraid or they just don't want to work or whatever it is, but they don't want to show up to work. And that could happen in, let's say, your small little local coffee shop. You have, instead of 3 workers, only 2 workers, and that will increase the lines. Now, of course, you might say, well, who cares about that? But of course, if you extrapolate that to the economy, if everywhere there is 1 worker less to do the job, you all of a sudden have less work being done, you have disruptions, and you have, therefore, the problem of inflation. What that means in practical terms is that either people have to wait longer for goods and services, or they have to pay more. For example, Tesla is a very good example. If you want to buy the most price-efficient Tesla, let's say a Model 3 standard range or something like that, you have to wait almost a year. If you want to buy a Model S Plaid, you can probably get it right now. So if you pay more, you get it, or you have to wait. This is, excuse me for the connection there, it might be scary for people, but it's kind of like in the Soviet Union when people were standing in line for bread and all that, because you either stood in line for bread, or you were powerful, or you had money, or you could bribe people to get the bread. This is roughly where we are right now in our economy. It's terrible to say that, to be honest, but it is what it is. I don't want to get too much into politics, but I would say that the mismanagement of the pandemic in the last 2 years, with the lockdowns, with all the fear-mongering, and then giving people either reason to drag their feet in terms of delivering the work that they're supposed to work, or scaring people. Some people are genuinely scared. I don't want to judge people, but the result is, in general, is that we don't have enough workforce to deliver all the goods and services that are demanded. Now, what it takes is somebody to come in, to use an analogy of history. We're on the path to a situation like we were in the 1970s, so we could have stagflation. The only way out of that is what happened in the 1980s, which is sort of what was called Thatcherism in the UK, or Reaganism here in the US. And again, this is not a political podcast. I don't care left or right. This could be a Democrat, or in the UK or in Europe, it could be a social democrat. I don't care what the parties are. What it takes is a strong hand that can put people back to work, which means that if you're sick, you stay home. If you're not sick, you go to work. There has to be a clear-cut distinction. If you can't pay your rent, you have to go into some sort of safety net, foreclosure, whatever it is, but you can't just stay in your apartment forever. These things can't go on. It just doesn't work like that. If we want an economy like that, then we have to rethink our economy. We have to think about a minimum wage. We have to think about what is the word? It eludes me right now. The minimal basic income. Things like that are absolutely in the realm of discussion. I'm not against them, but we can't just change the system right now, a system of free market, of entrepreneurship, of capitalism, and then just introduce things like, well, you don't show up to work and it's fine, just using COVID as a reason. That is not okay, because then we'll have inflation. And the problem is, this is not an ethical or moral discussion. I have my ethical and moral reasons to say that. I'm talking now about the actual practical situation on the ground. The people that are hurt most are the people that, let's say, we should be protecting the most. It's the vulnerable, it's the weak, it's the poor. They are hurting the most. If you have 6% inflation and you're worth billions, it doesn't really matter as much as it matters to somebody who actually is living paycheck to paycheck. So if anybody has a problem with, let's say, any kind of political insinuation here, there is one. I have my political views, and maybe they're transpiring in my comments. But if anybody has a problem, just think about, what is your goal? If your goal is genuinely to create a better, more fairer society, then you cannot tolerate inflation. You have to do something about it. And the best way to do something about inflation is to open up the economy, to let the flow of capital and let the flow of entrepreneurship and ideas flourish and deliver those goods and services. And if people get hired to do a job, they need to pay them, they need to be paid an adequate wage, but then they have to show up to work. They can't not show up to work because of COVID and things like that. It is not possible. There has to be a way for people who are scared, who can't work. They can be maybe put in sort of safety net, some sort of Medicare for people that don't want to work because they're scared or vulnerable. I'm not against any of that. I'm not propagating to punish people that don't want to work because of COVID or anything like that. This is not the point here. The point here is that we're intermingling the pandemic-related measures, which were short-term, with a long-term consequence that people don't want to provide labor at the adequate price. And we need to find a way to stop that. Otherwise, we'll have inflation, and that's a bad thing for everybody. Now, what does that mean for the business of hedge funds? Or the business of allocating capital to risk? It means two things. It means, first and foremost, that we have now a higher risk, which is the deterioration of government institutions. I had an episode, I put it in the show notes, it was probably a few months ago, where I spoke about inflation, and I identified three factors, three vectors that will drive inflation either up or down. Number one is I called it the sort of temporary effect of COVID, which I think is not too scary, which is simply the supply chains were shut down. We had a sort of cryogenic therapy for the economy where nothing was going on for a while, and just to restart everything will take a while. And I think we should be over that hump by now. But we're not. So why not? Well, second is the deterioration of government institution. I said that is definitely a long-term structural driver of inflation. Deterioration of government institutions means that we have higher healthcare costs, higher military costs. All these things that are under the control of the government will become more expensive, and that is a real concern. And the third, I said, that is going against that, that is the Cathy Wood argument, which is the disruption and the innovation in the economy, and particularly AI, which is driving down the cost of iteration of physical goods. And that is also an episode I had a few weeks ago, maybe, or even less, maybe 2 weeks ago, where I spoke about this, where I said that you have the cost of iteration in the physical market. So people like, let's say, Tesla, who make physical goods, who sell physical things like cars and energy, solar panels, they used to have the following problem set. Finding the problem was easy. You want to make an efficient car. You want to make an efficient solar cell. It's not so difficult to find the problem. The problem is to solve the problem, meaning to actually make that happen, because the cost of iteration used to be very high in physical goods. You have to make the prototype, you have to remake it, etc., etc. AI is going to help us massively to drive down the cost of iteration. Therefore, we believe that we can have a huge cost deterioration in physical goods. Take the car business, for example, that Tesla is disrupting right now. you will have disruption on the car itself, on the total cost of ownership through just using solar energy instead of fossil fuels, and then you also have the insurance. If you put that all together, I think you could have, let's say, if we're paying 60 to 70 cents per mile today as car drivers in the US, this could go down to 20 to 30 cents, maybe even lower. We're talking about at least half, maybe almost an order of magnitude lower cost of ownership for a transportation vehicle like a car, if you include robo-taxis and things like that. So this is a substantial lowering of cost, which will drive down inflation. So I said in that episode, I can put it in the show notes again, that we will have the first effect, this temporary readjustment of the supply chain will go away. Then I said that there will be sort of a fight, if you want, between the deterioration of the government institution, which will drive up inflation, and the disruption in the economy, which will drive it down. And we hope that Cathie Wood is right, that we will have a deflationary effect, because that is, in fact, it's better for us in the portfolio. We will make more money, generate more wealth, and it will be better for everybody else, for the people out there who are vulnerable, who are less fortunate, who don't have the kind of opportunities that other people have. They will be also benefiting, because they will feel it even more if, let's say, their total cost of ownership driving the car goes from 60 cents to 30 cents. That is real money in the bank for them. So having said all of that, we are now rephrasing our risk profile as far as inflation is concerned by pointing out that we believe that the deterioration of government institutions, particularly right now in sort of the power centers of the US, which is Washington, D.C., cities like New York and states like New York and California, we believe that the political situation there is such that the government institutions are deteriorating much faster than we thought. That is therefore increasing the risk of inflation. I mean, things like, for example, people are getting fired in New York if they don't vaccinate. All that kind of stuff is just increasing the disruption in the economy, making it much more difficult for people to deliver goods and services, and also, unfortunately, making it easier for people to be opportunistic when it comes to taking advantage of COVID. So we believe that that is a higher risk than we thought before, that we have to readjust our portfolio, and therefore we believe that also that we should be expecting maybe another drawdown of 20 to 30%. So that means that we could be back to 10 to 20% up for the year. That is unfortunate, but it's like I said, it is a risk we have to take into account. We can manage it in terms of leverage. We hope it doesn't happen. There's also the counter factors here, which is, for example, the political backlash that we also saw in Virginia, where people have had it with this whole COVID excuses and stuff like that. We already see it in states like Texas and Florida, which are flourishing. So we have the beauty of our system is there's a checks and balances. The political system is working as far as all these backlashes. I am not propagating to vote Democrats out of power or anything like that. All I'm saying is they're being shown the finger, and they have to either readjust their policies or they will lose power, which in both cases I'm fine. Just, I don't care who's in power. This is not a political podcast, but I want the people who are in power to stop the deterioration of government institutions, to help drive down cost of healthcare, safety, and to smoothen the whole supply chain issues that are right now plaguing the economy in the US and also around the world. So this is the way we see it. Again, it's just to be clear, we're stating that there is a higher risk of government institutions deteriorating, that therefore we have to readjust our expected returns for the near term. We thought that we can probably double this year again. The fund, we were up 60%, now we're up 38%, so we're already given up 20%. We believe there could be another 20% drawdown, maybe even more, not much more, but something along those lines. And that is driven by this increased risk. So that is the way we see the near future. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. This is very important for all the people out there who are running money. Have a sense for what could happen. Be prepared for it. Don't be the deer in the headlight when it happens. We are in this situation right now. There's no way out. Inflation is the inflation vigilantes are out there. Today, the yield of 10-year Treasury is up quite a bit. Now, I'm not a big fan of following the 10-year Treasury because the Fed is interfering. Nevertheless, it's up, and we just have to respect these things. We have to respect that there could be a further biting the political establishment in the back by inflation. Inflation is their constraint. They have realized that, hopefully, and they will do something about it. And what they can do about it is, like I said, it is to soften all these COVID restrictions and let people go back to work, and also force people go back to work. And if you don't want to work, it's fine. Then you step out of the workforce, and there should be a safety net for people. I'm not against putting them on the street, by no means. I live in San Francisco and I'm fed up with people on the street. I hope there is a better solution for that. But we cannot jeopardize the whole supply chain, the whole economy, for the sake of some sort of COVID-related fear mongering or whatever it is. It's the wrong thing to do. It hurts the people that are, even those who think they might take advantage right now, even those, if you're a poor person that doesn't pay their rent, doesn't go to work and pretends to be scared and collects a paycheck or whatever, it's not going to work for you. You're not going to get away with this, not because we're going to punish you. We don't care. It's the problem is you're going to be punished by inflation even more than other people that maybe you are saying, oh, well, they're rich and we need to tax them and all that. They will not hurt as much as you will hurt. So I think the right thing to do in this system that we have, and I said that a few episodes ago, if we agree on the goals, that our goal as a society is to increase opportunity for the next generation and to decrease, to have as little coercion by the state as possible while we're pursuing that goal. If that is the way we want to manage this system, this country, this thing that we call the United States of America, and generally the global economy of the Western world, which is leaning against the United States of America, if we want to preserve that world order, the post-World War II world order, if that is something we want, then we need to open up the economy, let free choice, let free will, let capital allocation take its flow, and then we need to save people, give people help in other means, not commingle those policies. Very, very important. Again, if somebody has a problem with the political system, with capitalism, all these things, that's fine. That's a different conversation. As long as we have the system, as long as we're embedded in this type of game with the rules that we play with, we need to loosen the restrictions, because inflation will hurt the people most that we actually want to protect. And that is something I think everybody should agree.